Hello, I'm Hunsley from Livewire Markets and welcome to the Undiscovered Fund series for 2024. Over the next 2 weeks, you're going to be meeting some of Australia's brightest investors and the small but mighty funds that they run. For this interview, we are going to be speaking with Tim Johnston, who is the Deputy Head of Australian Equities at Tindle Asset Management and Co-Portfolio Manager of the Tyndall Australian Small Companies Fund. Tim, welcome. Good to see you.
Thanks for having me.
So for anyone who doesn't know about what you do, tell us about why you launched this fund and how you went about it.
Well, Tyndall's been in the Australian market for the best part of 30 years. We've got a very proven investment process that has application into the small cap market. As to why now to launch the product, it's a combination of client interest as well as the resourcing within the team to do it, having hired a few new people in 2022 to build out the team and give us the capacity to launch the product.
Okay. So when I think about small caps, and especially Australian small caps, there are a lot of funds out there that compete in that space. So what would you say is your biggest edge?
I would say there's three things that differentiate us in the small cap space. Firstly, we are operating as a small group within a large team. So we're running a small cap fund, but we've got 10 other analysts that we're drawing on. Those analysts already covered down into the small cap universe, freeing James and I up to cover more stocks. In addition, those analysts are very deeply experienced in their respective sectors, and we're drawing on that expertise every day of the week. In addition to that, as being part of a larger business, we have the financial resources to undertake the necessary travel and access to expert networks that are necessary to give you an edge in the market. And finally, we're investing across the entire market spectrum. And we know a lot of small cap managers don't do that, and specifically they exclude the resources sector. That's for managers who don't have expertise there, and that's fine. If you can't do it, you shouldn't do it. But we have internal capability to invest in resource companies. Our head of equities is a former geologist, and our most recent hire is an ex-BHP employee who's got extensive experience across the minerals universe. So with that capability and the expectation that we're at the early part of a commodity super cycle, we think is an important part of the market to take an interest in, because the returns that are going to be available there will be quite significant.
So I find it interesting that this fund being launched right around 12 months ago. It's interesting timing, because obviously the gap between large cap and small cap share price performance has, depending on the way you look at it, only just begun to close, or certainly in the last few months. So what are you expecting for the next 12 months?
Yeah, we're very positive on the outlook for small caps. There's two main reasons for that. Firstly, the earnings outlook for small caps is vastly superior to large caps. So the consensus estimates for the small cap universe is about 10% per annum growth for the next few years. Contrast that to the large cap universe, it's sub 4%. So a vastly superior growth outlook. In addition to that, the valuation in small caps is relatively modest compared to large caps. So we think there's a multiple re-rate to be had in the small cap universe. And when you think about the de-rating that's occurred in the last 2 years, as it was a risk-off environment, as interest rates were going up, there's a lot of ground to recover. The small cap market had underperformed large caps by over 20% in that time frame. So there's a long way, a lot of ground to recover, and as a consequence, there's very strong earnings return outlook for the small caps.
Tim, can I follow you up on what you were just saying there? Because that's something that I hear from a lot of small cap investors. They say that the earnings quality is now better in the small end of the market, as you've just alluded to. It's supposedly better in the small end of the market than it is in the large end of the market. How do you know that, and what are you hearing from companies that would suggest that?
Yeah, it's an interesting point. I think there's two things to think about there. The large cap is where there's less value on offer, the larger part of the small cap market. And that's because in the sell-off that we saw through 22 and the first part of 23, there was a flight to liquidity. So that larger end of the small cap market is relatively more expensive. Further down the spectrum though, there's a lot of opportunities of companies with tremendous growth in front of them. And from talking to management teams across the market universe, there's a lot of operating momentum within their businesses and a lot of transparency about future demand. So they're very comfortable with the earnings, or the consensus earnings outlooks at an individual stock level. And in aggregate, it's a really healthy backdrop.
Okay, interesting. So one thing you mentioned there about momentum, rate cuts, I feel is one reason that we hear a lot about why small caps are supposedly going to do better and continue to do better. But we've seen those expectations really start to pull back, and not just in the US, but here in Australia, starting to be pared back as well. Does that concern you?
No, it doesn't concern me, primarily because I don't think central banks have lost control of inflation. We have seen a little bit of a surprise to the upside in near-term prints, but equally, we don't have the supply bottlenecks that really was the genesis of the really strong inflation prints we saw through 2021. And in addition to that, what we're seeing in labour markets it's not feeding into a cost push dynamic at this point. Labour markets are behaving themselves. Yes, there is wage growth, but it is not out of hand relative to the current levels of inflation. So I don't see that inflation is going to run away from us. In addition to that, I would say that our portfolio is not reliant on rate cuts coming through to deliver strong returns. We've got a diversified portfolio of high quality stocks which have a very, very positive growth backdrop. So we're not expecting or relying on rate cuts to deliver strong returns to investors.
Okay, well that's good to know then. So I guess the other thing too about small caps is that it has this reputation for being a riskier and a more volatile part of the market. What tools do you have at your disposal to mitigate both?
Yeah, it is riskier in the sense that the stocks are, I guess, more nascent in their development. They typically operate in more immature industries and therefore more fragmented industries. The consequence of that, I guess, is that they operate in a more competitive environment, a more dynamic environment. So the range of outcomes 5-7 years forward is greater than you might expect in the large cap universe, which is operating in stable, mature industries, lower growth prospects, but also a narrower range of outcomes. In addition to that, small cap stocks, and probably as a consequence of that, small cap stocks do have less access to capital. And then thirdly, liquidity is obviously the third factor, which adds to that volatility. And as we've seen in the last year, a flight to liquidity whenever there's any hint of trouble. So how do we deal with that? Well, firstly, we're very focused on quality stocks. We're very focused on the durability of a company's business model, the industry structure they're operating in, the strength of the management team, and also importantly, the strength of the balance sheet. We monitor and manage our exposure to the smaller end of the market, very cognizant of the liquidity that's available there. So we limit our size, the size of our positions in that smaller end of the market. And then thirdly, we've introduced a couple of additional risk tools which allow us to monitor and manage our macroeconomic risk across the portfolio.
Okay. A follow-up question on quality, if I may, because that is a question I've been asking lots of people over the last year or so, and everybody seems to have a different definition of what is quality or what constitutes a quality stock. What does quality mean in the Tindall sphere? What does quality mean to you?
Well, there's a few dimensions that add up to be a quality stock. Firstly and foremost, it's the durability of the business model. Is this a business that will be around in 5 years' time? Does it have barriers that will protect it as competition emerges, as technology changes? Secondly, is the management team experienced? Have they delivered in their prior working experience, and do they have a good track record? And then thirdly, from a financial perspective, what sort of returns has it generated? What's its pricing power? And in addition to that, what's the strength of its balance sheet? So it's a combination of factors. There's no one factor that you can point to that says that's quality, but rather, there's a range of different measures that you need to take into account.
Yeah, no, understood. So it's an equities fund, obviously. So let's start talking about stocks. Tell us about your largest holding and why you bought it.
Largest holding at this point in time is AUB Group. AUB is one of the largest insurance brokers in the country. Insurance brokers organise insurance products for small and medium-sized businesses. Why we like it is because it's got both very defensive characteristics but also tremendous growth prospects. That's an unusual combination. It's defensive because the products that it sells are largely mandatory insurances that businesses have to open their doors. And secondly, the customer base is very, very sticky. We like it because the growth prospects are very good, and that's coming from a few different sources. Firstly, there's growth in the number of businesses in the Australian economy, which might surprise a few people. ABS data shows that from 2019 to 2023, there was 13% more businesses in Australia, so that's underlying growth for the likes of AUB. In addition to that, the insurance cycle is very, very strong, as the general insurers are having to raise their premiums to recoup the higher cost of claims and also the increasing incidence of weather events. And then in addition to that, the AUB's been consolidating the industry and adding to earnings growth through acquisitions. So all of that combined is a very positive outlook. And it's also trading at a very reasonable price, I would say. It's trading at about a 15% discount to its closest comparables, despite having a more robust growth outlook.
Okay, so that's your largest holding. Maybe tell us about then a recent addition to the portfolio, not just why you like it, but also about some of the risks maybe that are associated with that investment.
Sure. A recent addition to the portfolio is WA1. It's not a very well-known stock. It's an explorer operating in Western Australia, but it has found a niobium deposit. Now, niobium's a little known metal, but it's essentially used to strengthen steel. Why we like it? Demand backdrop is very, very good. It's on the US critical minerals list. It's used, as I say, to strengthen steel, and the backdrop for steel is very robust because pretty much every renewable project that we think about has got steel in it. And then on the supply side of things, it's also a very positive story in the sense that it's a very concentrated market as it stands, and the largest player in the market controls about 80%. And what we've seen of their behaviour is it's very, very rational. Whenever more supply comes to the market, they just cede a bit of share to keep prices very high. So with that backdrop of strong demand and a very rational supply side, there's a very real possibility that this is the next large niobium deposit coming to the market. And in terms of the risks, obviously this is a deposit that's still being proven up. The key risk at this point is the metallurgy. Are there deleterious elements that are co-located with the niobium that make it either difficult to extract or difficult to liberate from the ore? We don't have full assay results back from the lab yet, so that's a key risk and a reason that we've only taken a small position in that company.
And if those results were to come back positive, that would be your cue, I guess, to increase the positions?
That's right. That's right. Yeah. If they come back with no issues, it's obviously a much more attractive proposition, and we would, subject to price, add to that position.
Tim, from insurance to niobium, very diverse there. Thanks for joining us.
Thanks very much for having me.
And thank you for watching. You can now watch the rest of the Undiscovered Fund series on livewiremarkets.com and marketindex.com.au. Thanks for watching.